Welcome back to the deep dive. We've got quite a stack of sources today, and they paint a really complex picture of what's happening in Korean finance right now.
Yeah, it's not straightforward, is it? Not just boom or bust.
Not at all. It's more like finding the friction points,
Yeah.
where the system's under pressure, where big policy ideas are clashing with, well, market realities.
What I find fascinating is we're looking at three really distinct battlegrounds here, all happening at once, but on different levels.
Exactly.
It really shows the tension, doesn't it, between, say, national stability goals, how the market actually behaves, and then, basic consumer rights.
You couldn't have said it better.
Yeah.
So that's our deep dive today. We're zeroing in on these three spots. First, how banks are being kind of pushed into helping low-income borrowers,
Yeah.
trying to soften this credit crisis point,
The interest rate cliff.
right? Then second, we're looking at the regulators, the FSS specifically, and their pretty aggressive new stance that came out during that parliamentary audit. They seem determined to clean house.
Oh, yeah. Big signal sent there.
And finally, something maybe more relatable day to day. This really surprising gap in the rules about credit cards that's leaving a lot of consumers, well, pretty frustrated.
It's a perfect storm in a way. You see attempts to manage risk at the bottom, the regulator trying to impose discipline up top,
Uh-huh.
and then, like you said, these blind spots smack in the middle where everyday consumer stuff just gets missed.
Okay, let's start there. At the bottom with this interest rate cliff. Jumari Julbyuk, they call it in Korean. It's not just a phrase, it's this huge gap, right?
It really is. It's where working class folks, people who need credit but banks see as too risky, they get forced into these really high interest loans from non-banking firms.
And that cliff got way steeper a few years back.
Exactly. Back in 2021, when the legal maximum interest rate got slashed to 20%, the worry was, okay, if you cap the rate, maybe legitimate lenders just stop lending to these people entirely.
Pushing them towards illegal loan sharks, maybe.
Precisely. So the banks, or rather the system, came up with this indirect fix, the Good Actor Loan Company system. It's been around about 4 years now.
Okay, good actor loan companies. So banks lend to these certified loan companies.
Right.
Who then lend to the actual person needing the money. Why the middleman, though? Why is that indirect route so important? Can't these loan firms just borrow from savings banks or something?
They could, sure, but here's the key bit, the economics of it that makes it work for the consumer. Banks lend to these approved good actor firms at maybe 5% or 6%.
Okay.
If those same frames went to a savings bank, they'd be looking at minimum 7% to 8% interest.
Okay, only a 2 percentage point difference. That doesn't immediately sound like a game changer. Why all the fuss about that small saving?
But it's leveraged, you see. Think about how the loan company sets its final rate for the consumer. They have their borrowing costs, plus they have to add a big chunk on top, often another 10, maybe 14 percentage points.
To cover bad debts, operating costs,
Yeah.
all the risk involved.
Exactly. It's high-risk lending. So if their starting cost is 6% instead of 8%, that entire 2% difference they saved, that's pure savings they can pass on.
I see. So it directly lowers the ceiling on the rate the end borrower pays.
Precisely. It makes a real difference. For someone needing a small working capital loan, that might save them thousands of won a year. Or maybe it's the difference between a rate they can just about manage and one that tips them over into default.
So it's genuinely helping keep things stable for those working class citizens.
So that's the policy goal, yeah. Meaningful support. According to the data, end of June, banks had about 215.4 billion won out to these firms. That's like 7.2% of their total borrowing.
Still, I hear the banks themselves are a bit reluctant, worried about the PR, maybe. Like they're supporting high-interest lending.
And that's the paradox, isn't it? Experts are pretty clear. Banks need to do more of this lending because it actually lowers the rate for the most vulnerable borrowers.
So criticizing them for it is kind of missing the point.
Completely counterproductive, yeah. And it's not like this is unheard of elsewhere. There's precedent.
You mentioned Japan.
Right. Japan lowered its maximum rate back in 2010. And what happened? Major Japanese banks actually started running loan companies as subsidiaries. They stepped in directly.
So they actively manage that part of the market.
Yeah, they kept legitimate credit flowing to that higher risk group. It shows that sometimes this kind of indirect action is, well, necessary to avoid just cutting people off completely.
Okay, let's shift gears. From trying to help individual borrowers, let's zoom out to the whole financial system structure. And this is where, wow, things got heated recently.
Definitely. We're moving from that sort of gentle support policy to some pretty raw flexing of regulatory muscle. The FSS governor, Lee Changjin, made some big statements during the parliamentary audit that Gukgam.
He really signaled a change in approach, didn't he?
Zero tolerance seems to be the message, and he went straight for what he clearly sees as a huge systemic risk, the C-Mall Gimgo network.
The Korean credit unions, why are they seen as such a big risk? Is it just their size?
It's the size combined with, well, some pretty worrying internal numbers. It's this huge network, right? Local community finance places. But the governor pointed to their non-performing loan ratio.
The bad loans.
Yeah, loans unlikely to ever be paid back. It's sitting at 10.7%.
Wow, 10.7%. That sounds incredibly high.
In a normal commercial bank, that would set off major alarm bells. Panic, probably. For a sprawling, decentralized network like this, it's a threat to stability in whole regions.
And his proposed fix was pretty dramatic.
It really was. He basically said, look, about 1/3 of all C-Mall Gimgo branches need to be merged or consolidated. Now,
Just like that. That's a massive intervention.
huge. It's a very public statement of intent to get deeply involved.
But then it immediately got messy, right? This whole issue of who's actually in charge. Jurisdiction?
Ah, yeah, the underlying drama. See, the FSS doesn't actually oversee C-Mall Gimgo directly. That's the job of the Ministry of Interior and Safety, MOIS. So the FSS governor claimed MOA was now suddenly willing to hand over supervision. But then MOIS came right back and said, no, we didn't agree to that.
So confusion and finger pointing right when you need clarity.
Exactly. It turns what should be a financial stability measure into this bureaucratic turf war. Doesn't exactly inspire confidence in the market.
And it wasn't just C-Mall Gimgo. The governor also made a play for more power for his own agency, didn't he? For the FSS's Special Police Unit.
Yes. The Special Judicial Police Bureau, or Tuksagyong, he called them a crippled special police right now.
Crippled how?
This is key to understanding the shift. Currently, they can't start their own investigations. They lack what's called Inje Susa Guanhan. They can investigate, but only respond to cases brought to them or referred.
So they're reactive, not proactive.
Exactly. And the governor argued this limitation isn't even in the main law, the Criminal Procedure Act. It's apparently just an internal supervisory rule set by the FSC, the Financial Services Commission.
So he's saying, let us off the leash. This is just red tape stopping us from policing the market properly.
That's the message. Give us the power to initiate, to go after things we suspect, not just wait for referrals. It shows a real desire for more direct enforcement capability.
And we saw hints of that aggressive approach even before getting these potential new powers, right, when he talked about corporate governance.
Oh, absolutely. He didn't hold back. He specifically called out MBK Partners, a big private equity fund linked to that Home Plus deal situation.
Right, I remember that.
He basically warned that funds showing moral hazard, doing things that are risky or unethical because someone else bears the cost, should be kicked out of the market.
That's setting a strong precedent for private equity.
Extremely tough talk, very early on. And it wasn't just talk. Look at BNK Financial Group.
What happened there?
The governor publicly criticized their CEO selection process. And almost immediately, boom, the whole process gets put on hold, delayed, pending a potential investigation.
Wow. So his words alone were enough to stop a major bank's leadership selection in its tracks.
It shows the immediate chilling effect this new regulatory attitude is having. Standard corporate procedures are suddenly under a very intense microscope.
Okay, so we've seen this push for stability at the bottom and this assertion of power at the top. Now let's talk about the middle, the everyday consumer stuff, because there seems to be a disconnect.
There really does. Let's talk about your credit card suddenly vanishing.
Right, something that probably hits a lot of our listeners right where they live. That Hyundai card example was pretty stark.
Yeah, the Starbucks co-branded card, hugely popular card, lots of people had it. Then the company announces on the 14th of the month that it's being discontinued at midnight on the 15th.
Wait, seriously, like 1 day's notice?
Pretty much, yeah. Effectively same-day notice for a product people use constantly for budgeting, for points, for just daily spending.
That's genuinely shocking. I mean, for my phone plan, my internet, anything else, you expect weeks, maybe months of warning if they're changing things. How can credit card companies legally just pull the plug like that?
And that's the kicker. It's a regulatory blind spot, a loophole. The current standard rules, they do say companies have to give you advance notice, but only for service changes or benefit reductions.
So if they cut your reward points from 2% down to 1%, they have to warn you.
Correct. Weeks in advance, usually. But there's apparently no specific rule covering product discontinuation, just getting rid of the card entirely.
So because they're not changing the service, they're eliminating it, they don't fall under the notice requirement. That feels wrong.
It feels like gaming the system, doesn't it? It gives them this totally flexible rubber band notice period. The sources showed Hyundai Cards notices this year for different cards varied wildly one day for the Starbucks one, but up to 40 days for others.
No consistency at all, just
Yeah.
whatever suits the company.
Seems like it. It lets them prioritize their own efficiency, maybe cost-cutting by axing unprofitable cards, over giving consumers any reasonable time to adjust.
And this isn't just Hyundai Card or just a few niche products being dropped, is it? It sounds like a much bigger trend.
Oh, it's surging. It's massive. In the first half of this year alone, something like 400 different types of credit cards were discontinued across the industry.
400 types.
Yeah, that's apparently 1.7 times more than the previous 6 months, an all-time high.
So companies are actively using this loophole to prune their offerings, regardless of the impact.
Looks that way.
Yeah.
And experts are, understandably, quite critical. They're saying this really messes with consumer choice, with people's financial planning. And they're specifically calling on the FSS.
The same regulator flexing its muscles elsewhere.
Exactly. They're urging the FSS to step in and set clear, mandatory rules. How much notice do you have to give before you kill a card product? Hashtag tag outro.
So let's try and wrap this up. We've covered a lot of ground. We've seen this quite sophisticated attempt to help low-income borrowers indirectly through the banks and loan firms.
Trying to shore up stability at that level.
Right. Then we've seen the top regulator, the FSS, asserting this huge new power, aiming to enforce discipline, clean up big risks, like same old Gumgo.
Very top-down approach there.
But then, somehow, in the middle of all that, this basic, practical issue fairness for credit card users, giving them decent notice, seems totally overlooked by the same regulatory system.
And if you connect those dots, it really sets up the big question, doesn't it? For the FSS governor, for this whole new aggressive regime, they're spending enormous energy, political capital too, on systemic stability, tackling bad loans, corporate behavior.
Big picture stuff.
Right.
Wow.
So the question for you listening is maybe. Which fight do they prioritize? Where does the energy go first? Is it the huge systemic cleanup like Same Old Gumgo? Or do they also address these immediate, very visible consumer protection gaps like the credit card rules?
Yeah, that choice will tell us a lot about whether this regulatory push is really comprehensive or if it's just focused on the biggest headline-grabbing threats. Something definitely worth watching.
Absolutely. Keep an eye on how the FSS uses its powers, or maybe its new powers, and where it decides to focus in the months ahead. It's going to be a dynamic time for Korean finance.
We'll certainly keep tracking it. Thanks for tuning in to The Deep Dive.